Well, the number one question, of course, is how does this impact me, right? And there's no simple answer. There's so many changes in this bill. This is, as we all know, one of the biggest rewrites, actually the biggest rewrite of the tax code in the last 3 decades. So people have no idea how this is going to impact them. Some people think they're going to end up paying a lot more tax. Some people think they'll pay a lot less tax, and not all of them are right.
But I mean, specifically, are they saying, should I move? Should I buy heavier dividend stock? Should I...
Sure.
How can I minimize my state and local property tax? What specific questions?
The most specific question people have asked is, should I pay my state income tax now for next year? And unfortunately, that's one of the things that was crafted very adeptly into the bill, that if you prepay those state and local income taxes early this year, you won't get a tax break in 2017. When they drafted the law, they kind of foresaw that.
So don't bother. The part of this bill, or the soon-to-be law, is about alimony, which could affect a lot of folks out there as well.
That's huge. That's huge. And that's one of the few things that's permanent. This change says that there's no more alimony deductions after 2018. Now, the good news is that at least this is one of the few areas where there is a grace period, right? There is 1 year to finish this. But as I'm sure you know, we all have friends or family that have been through the divorce process, and it can be brutal. You might start that process now, and it might take the entire balance of 2018, and you still might not have an agreement. And if that agreement isn't in place by the end of next year, the person paying that alimony will not be able to deduct that expense.
So you have until the end of next year in order to deduct that alimony expense. Is that correct?
Well, that agreement has to be in place by then.
Right,
yes.
in place. There's one thing that I didn't know, and that is a mortgage interest deduction. We all know that it's capped now for mortgages up to $750,000. Other mortgages are grandfathered in, but this could exist on 2 homes, right?
You know, anytime you have a change to the mortgage interest rates or the deductibility of mortgage interest or the deductibility of property taxes, all of these things go into homeowners deciding whether or not they want to buy a house, whether or not they can afford a house, how big a house they can afford. So, of course, that's absolutely going to have an impact in some way, shape, or form on the housing market.
Yeah, but to clarify, I was under the impression that you could deduct up to $750,000 on one house. Now it reads in the notes, I see that actually it could be more than one house as long as it maxes out at $750,000.
That's correct. You still get the first and second house. So that was left in there. That's really a break for obviously the very wealthy, because most people don't have 2 homes. But yes, that is true. You can still get those 2 homes with the mortgage interest deduction, but they are eliminating the home equity loan deduction with no grandfathering.
Should I buy dividend stocks?
Good question. You know, I don't really think this is going to materially move that discussion one way or another. At the end of the day, I think you buy good companies, good investments, and you hold on to them. That tax, of course, there's a tax equivalent yield that plays in here, but I don't see this really making dividend stocks any more or less attractive over the long run.
Isn't there a different treatment, though, for taxes, or will there be a different treatment for REITs? REITs currently now are the dividends that you receive from REITs are taxed as capital gains, but under the new law, they'll be treated as pass-through income, so it'll be a lower rate effectively?
You know, that's one of those areas where there was a last-minute throw-in. There's a few different deductions there on business income, on pass-through income. So one of them is a test on wages. For lower-income individuals, there's actually there's no rule on wages or on the depreciable property. But for individuals with much higher income, that can be phased out. However, there are 2 provisions in the law. One says that if you pay a certain amount of wages, you can still take that 20% pass-through deduction. The other one says if you pay a lower percentage of wages, but you have a significant amount of depreciable assets, then you still may be able to take some of that or all of that 20% deduction. It's one of the more complicated provisions in the law, without a doubt. It certainly didn't simplify anything.
If I have the choice between making a charitable deduction in December or in January, what should I do?
There's no precise answer to that. One of the questions you'd have to ask yourself is, what is the likely impact of the change on you? For instance, I'll give you a classic example. Let's say you're a married couple today, and you've got about $15,000 of itemized deductions. Today, you would actually claim an itemized deduction because your itemized deductions exceed the standard deduction today. However, next year, if we go to this $24,000 standard deduction for a married couple, that $15,000 worth of itemized deductions are meaningless because it's less. So if that was you, if that was the case today, absolutely you want to make that charitable contribution this year because you won't get any benefit for it next year.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.